Welcome, everyone. Today I'm joined by Managing Editor James Kleimann to talk about layoffs at Rocket, pricing strategies at UWM, and how lenders are reacting to changes in loan level pricing adjustment fees. James, welcome back to the podcast.
Hey, thanks for having me, Sarah.
Thanks for joining us, even though you have a cold. Very valiant of you. I know you've been battling this, but we have so much news to talk about. I'm really glad you joined.
We do, yeah. For the listeners that are not aware, I have a 13-month-old son, which means he is always sick from daycare. And so in turn, I am always sick from daycare. So we get to do it together. It's a fun little bonding exercise.
Oh man, I feel so bad for parents right now, especially you're in New York City. And I know that right now it's just like COVID, flu, RSV. I mean, a ton of stuff.
Yep. Yeah. The terrible trio.
Well, let's turn to some news. So we had unfortunate news from Rocket on layoffs, although they're pretty small layoffs. Lead us off with that one.
Yeah. So Rocket late last week told roughly 50 employees that they would be getting the pink slip. And, they didn't offer a ton of details. They typically don't. But it's a relatively small number. We need to remember that Rocket is beyond just a mortgage lender. They have other operations, and they're a very big company. They have, I would say certainly over 10,000 workers, and they're across a few different campuses. And so what we could tell is that it is going to affect a lot of folks in operations. It's going to affect some who are in kind of the tech software sector within Rocket. And, it's not unexpected. Rocket has already made one round of layoffs, and they have for quite some time been asking workers to raise their hand and say, you know what, I'm going to take a buyout. I'm going to leave. I'm going to take a generous severance package. I'm going to take, really solid health benefits. I think it was like 6 months or something. I could be wrong, but it was definitely above, kind of the typical industry standard. And it's going to be really tough for a lot of these workers right now because the job market is just not as good as it was when those voluntary buyouts were on offer. And so I think really what it says is everyone has their back against the wall, and every lender out there is vulnerable because nobody's doing better than they were a year ago. Rocket has never been, top of the heap in terms of purchase volume. And so they're having to make these tough choices. No one I've spoken to, no one her reporters have spoken to think that Rocket is in any kind of danger. This is still a really well-capitalized company. They are very focused on the long-term vision of integrating these various businesses that they have, whether it be in title, whether it be in sort of these kind of personal money apps, right? They want to get you into the what do they call it? It's one of those business terms, but like get you into the funnel or whatever. I don't talk in jargon. So it's, but that's their goal, right? They want to get everybody from these different kind of sectors into the Rocket experience. And then, they sell you auto insurance, they sell you title insurance, they sell you this, that, right? So, but it's a setback for sure. It's not, it's not great.
I do think, to your point of how big a company it is, and then the number of layoffs. If we look at the tech companies, which are gigantic, right? I mean, they're very, very large. Massive. And they're doing, tens of thousands of layoffs, but almost all those people are people they hired, over the last couple of years when times were good. And I think it's the same thing that, this is how companies stay profitable and all that. So in context, it does seem
more
small,
profitable,
but notable. Yeah.
Right.
Yeah.
I mean,
yeah, absolutely. And, the whole point is like, to your point, it's not even necessarily like, oh, we're losing money or whatever. It's like, if those people don't have something to do, there's no reason for them to be there. So
I think the flip side to this could be, if you think about all the jobs that have been shed in tech, a lot of entrepreneurship comes out of tech. There are a lot of people who made, I have a buddy who worked at Facebook, and he did really, really cool stuff. And he made, the amount of money he makes is like a little sickening personally. It's a ton of money. And you know what? He's a very entrepreneurial guy. He's going to be just fine. He might start up his own business. He might end up hiring people a few years from now. This could end up being, an event that kind of triggers a mini tech boom a few years later, right? There were so many people who made good money who probably decided, you know what? a lot of companies are never going to treat you like family despite, what they say. And maybe I should just strike it on my own.
Well, let's turn to some other big news that, we had a story. The mortgage industry is nervous about LLPA fee changes. So that's the Federal Housing Finance Agency, which last week made a series of significant changes to loan level pricing adjustment fees, right, charged by Fannie and Freddie. So tell us what that story is about and what you think the impact is.
Yeah, so I would probably need a translator to properly articulate all of the nuances. It is very technical. It is very heady stuff. But the long short of it is, depending on one's viewpoint, the GSEs, Fannie and Freddie, under the FHFA are effectively trying to boost their affordability goals. And to do so, they're raising fees on certain types of borrowers within certain, they call it grids, but basically within the pricing matrix, right, of how the GSEs buy loans, conventional conforming loans. And I think the takeaway here is this could be really beneficial for first-time home buyers. It could be very beneficial to those who have, let's say, adequate, like pretty sizable down payments, but really don't have the credit scores that necessarily lead to lower fees. If you have perfect credit, if you are, an 810 borrower, whatever even the number goes up to, like, you're at the very tippy top of the scale. It's not like you're suddenly going to be paying like $15,000 in LLPA fees. I don't want to make it sound like suddenly, they've not only robbed Peter, they've also robbed Paul, and they're giving it all to Jeff. It's not exactly that. But what they are doing is they're going to be making it, I think, a little bit more difficult for the middle of the road buyer. Maybe the average income borrower who is, let's say, putting 20% down. They're going to be penalized today, not today, in May, starting in May, more so than they had been under the old LLPA rules. And I think it's also going to cause a lot of confusion and a lot of challenges between sort of the LO side of things when they take all of the statements and they compile all of the information from prospective borrowers versus when it gets through the underwriting process, right? Because one of the main things here, I think, if not the big takeaway, maybe the second big takeaway here, is they now have a DTI component, debt to income ratio. And that is going to change the calculation. You can get pretty creative when you're calculating people's income, right? And maybe when the borrower approaches the LO and says, "Hey, here's my income. Here's what I've got. Generally, this is what my credit looks like. We're going to be around like the 690 or 7, whatever. And here's my down payment. And here's my income. And I got a little bit of freelance money. And I've got a salary from this. And then I left that job and I got this. And I'm going to declare that. But I also have income from here. And that's like whatever." Or let's say you're a self-employed borrower, it can get very, very creative on the accounting. And then when it finally goes to underwriting, the underwriter is like, "Oh no, like that doesn't quite conform because you're at a 43% DTI now. And so the fees are different. The fees are higher. And so unless you have, like the full workup, it might lead to a lot of problems in that process. It could lead to a lot of frustration, certainly for the borrower. But I imagine, there may be some conflicts that arise between the LO and the underwriting department. So that is particularly interesting to me. I had quite a bit of feedback that came in when I wrote about this story on Friday. And so there's a guy in Dallas who said, "I imagine there will be a huge number of in-flight changes to pricing causing lender cures. Lenders will need to overestimate the cost of home insurance and HOAs to help avoid LLPA charges. And underwriters will need to look to including additional income not needed for qualifying, but might be needed for avoiding LLPA changes. And there will also need to be adjustments to the competitive quoting process. It's very normal to offer quotes based on what borrowers describe as their financial situation, like the credit, strong income. But it's also very common for files to change once they've been through underwriting, especially for self-employed borrowers." So, in his estimate, there's just going to be a lot of confusion, and it's going to be more expensive for borrowers. It's going to be more complex for them, the lenders to manage. And, it will also make quoting accurate rates much more difficult. There are so many borrowers out there who just, they're like, oh, maybe I want to buy a house. So they throw in some numbers into the calculator online. It goes to like, Lending Tree or any number of those type sites, Bankrate, just for example, and they put in kind of very basic preliminary information, and it spits out, like, oh, here's what you would qualify for at lender A and lender B and lender C and lender D, but without knowing, all of these LLPAs now and the fees that are now associated with how much you want to put down, what your income is, where you fall within the credit bracket. It could be very different. You could be paying thousands more in fees now that maybe you didn't have, right? And maybe that changes, what you qualify for or what you want to buy, or maybe the lender will offer credit. I don't know, but it's going to be more complex. And for a lot of lenders right now, that's the last thing you need, right? Like you want simple, you want clean, you want easy. And then there are questions as to, are you now trying to have, from a policy standpoint, the GSEs competing with the FHA? And then there are questions about the NMI fund, right? And whether that should be, reduce those fees so that, you're not basically pitting these enterprises against one another for other borrowers that they're then using to subsidize. It's tricky. It's definitely tricky, and certainly it is a policy initiative of the Biden administration to make it easier for first-time homeowners, to make it easier and cheaper for underserved borrowers to get that house. But the LOs, the branch managers, the executives that I've spoken to say, look, maybe in theory, these are good intentions. But if you look at the dynamics of the mortgage market right now, of the housing market right now, are these borrowers even competing for homes? Are they, even with, a few incentives here and there, a few reduced fees, does that make enough of a difference for them to actually win the home? If it does, great. That's maybe a fair trade-off depending on your perspective. But if it doesn't actually move the needle enough for those borrowers to get the house, and it does penalize the middle of the road borrowers, or it also penalizes investors, and all kinds of others. And I don't need to get into that. I don't think the investors, are going to need my tears. But it does make you wonder, is this good policy at the end of the day? If you want to spur activity in the market, if you want people buying, selling, if you want a healthy market, is penalizing the middle of the road borrower to subsidize, those in maybe a few brackets below them in terms of credit and income. Is that good policy? I think a lot of people that I've spoken to would say no, but it's not for me to say.
You reached out to the Mortgage Bankers Association, National Association of Realtors, and it feels like they echoed that, where it's like, we applaud the idea of doing this for lower income borrowers, but is it going to make a big enough difference to justify the hit? Is that, would you say that sums it up?
Yeah, I mean, both definitely cautioned, hey, this is really dense. You're basically like, to me, it's like looking through like numbers. It's like a Fibonacci of mortgage. It's very dense. It's very technical. You're trying to figure out what changed across like a various grouping of numbers, and it's complicated. So they're still reviewing it. They're still trying to figure out exactly who's going to be affected and how they would be affected. But yeah, I think that's a pretty fair summation of their concerns, that they applaud the idea, that they also, I mean, look, like the NAR, the MBA, they also want more people to be able to buy homes.
Right.
This is not in opposition to their goals. But if you're doing it at the expense of a group that is, generally better positioned to, make that leap in the housing market, I think that presents a conflict. And yeah, they're rightfully concerned.
And I know that you said that the investors don't need your tears. I feel like investors are kind of in the crosshairs of this administration. They've done some things that definitely feel like, they don't they don't want that. But I mean, that is a part of a functioning mortgage market, is to have people buying homes. That's still, you're paying real estate fees on that. You're paying, your loan fees on that, your mortgage fees. And then, you might be renting that out to someone who needs it. So I might have some tears for investors as someone who's bought real estate as an investment property. I mean, I do feel like that's notable.
Yeah, no, absolutely. And that is a really foundational part of the housing ecosystem. You need people who are buying, who have the capital, who have the discretion to, maybe take a small loss over a period of time for a bigger opportunity down the road. Like, you definitely need, you need investors who are willing to rehabilitate units that otherwise would be sitting in disrepair and not used, right? Like that's a really important part of it. But I also think, like, generally speaking, it is hard from a policy position to get politicians to say, yes, it's the guy in the suit who's looking to spend, however much money on this home that he's then going to rent out, even if it is a global good, and that can be debated, of course. But definitely it is not, there's no like yeoman farmer of the housing market right now, right? Like there's no like archetypes that I think everybody can rally around that is deserving of both sympathy and money and subsidy from the government. And so, I think it's also true that a lot of the policies that have been enacted by the Biden administration have made it more difficult for investors to make money. And that's not going to change by the looks of it. A lot of these policies, even though, to their credit, the FHFA have relaxed a few policies that were put in place that really did not help. But, that's also on the part of like mortgage investors, right, on the MBS market. So it's complicated, but I think this is probably going to just result in more red tape, more bureaucracy, more confusion, more difficulty. If you're a well-positioned borrower and you have 20% down, you have, really good credit. Let's say you're in, historically, credit scores have only been going up for a while, right? And last check, God, it must have been like 2020 or 2021. Like the average credit score was like 760 or something.
It is really high.
It was really, really, really high. And so probably if they really want to buy that home, they can afford to, pay an extra $1,000 in fees. It's not great, but that's probably the trade-off that the FHFA is making here.
Probably. So I do wonder about, because I saw that report that you had to go through the what the FHFA put out, and it was like, wow, that was
a nightmare. Yeah,
it was a nightmare. So are they waiting till May because it's going to be integrated into the automatic underwriting systems that they provide, that Fannie and Freddie have? I mean,
yeah. I mean that these are pretty complicated. These are very detailed matrices. And the lenders need to get everything ready as well. They need to make sure that everything that goes through DU matches up, that there are no unforeseen problems. Of course, there always will be, right? I mean, that's how any integration goes with any sort of tech or any major change in underwriting in any sector. If you're a wholesaler who invests in Spanish ham, like when there's a change, like there's going to be a hiccup here and there. The trade groups have requested that the GSEs and the FHFA, by extension, delay the implementation of the deadline. They're integrating other changes that they announced in January of 2022 and in October of 2022. So those will probably be there and ready to go. Maybe some of the new changes that they've just announced, they might get delayed. We do know that the FHFA has shown a willingness to delay certain implementations. The FHA as well has done that, right, on some of their changes to capital requirements. So I think there is a willingness, generally speaking, on the part of the government to give people a little bit of time to get their ducks in a row. But it's really hard to say. I think you kind of have to prepare for it, because if you're starting the underwriting process, if you're originating the loan in March or April, very good chance that that's still in the pipeline on May 1st. And boy, explaining that to the borrower, oh, I'm sorry, there was a delay, and you're now going to pay an extra $2,700 in fees. Uh, yeah, whoopsie, sorry about that. I mean, that would really sink a reputation, right?
Absolutely. Better safe than sorry on that one.
So the reality is, like, they need to make it, if they're going to delay it, they have to say so very soon, because you have to start underwriting those loans, that are going to be hitting origination desks in March, early March, right? Just to be sure. And if it's a more complicated loan, even if it does like a vanilla conventional conforming, but maybe there are some complicating factors to it, it's going to need more time. Absolutely.
The last thing I'll say about it is that it's interesting that as we've seen over the last, 6 months, so many lenders laying off operations staff and underwriting staff and people who could maybe help on some of this. That's going to be, as you said, not great news for them.
Well, maybe this is good news for the underwriters. I mean, when we think back on the timeline, Sarah, they were commanding their own price in a lot of cases in 2020 and 2021 because they had this unexpected boom that no one really saw coming, and few were really prepared for. And so they did really well in the pandemic years. And then volume drops, and suddenly underwriters, are really the first victims of the cycle, right? At least in the mortgage world. And now, like, if you have a lot of, let's say you have a lot of complications integrating the new LLPAs into your process, that could be really good for some experienced underwriters who know, do you like the back of their hand, right? So, and I should, for those who are not maybe as fluent in mortgage, this only affects Fannie Freddie conventional conforming. We are not talking about FHA or VA or non-QM or anything else. But yeah, I mean, it could end up being kind of like a very small bump in underwriter jobs coming back, because look, like, if you can't originate conventional conforming mortgages, like, you're going to have a real tough time at it.
It's going to be an even worse 2023 than last year. Well, the next one I wanted to talk to you about was UWM. So we started off with Rocket. We'll end with UWM, the big rivals. Basically, the company announced last week that it's giving up to 125 basis points to brokers who use to use on any loans they lock with UWM. Let me just do that over again real quick. Sorry. UWM. Oh boy. Okay. The company announced last week that it's giving up to 125 basis points to brokers to use on any loans they lock with UWM, with a maximum of 40 basis points per loan. So there's that original story, and then there's a follow-up story we did. Tell us a little bit about that.
Yeah, so this is a really interesting one. So UWM has always been a really aggressive lender. It's pretty transparent about wanting to be number one, and then the way that they get there, it definitely ruffles some feathers sometimes, right? So I think kind of the big announcement was, I want to say, like 2 years ago, that they did the ultimatum, right? So they basically told broker partners, look, if you do business with us, you can't do business with Fairway, you can't do business with Rocket. And then last year, and so that led to lawsuits, antitrust lawsuits that are still winding through the court system right now. And then last year, they announced that they would be reducing prices on all loans between 50 and 100 basis points. And that led to some accusations from rivals that they were basically making it impossible for others to compete in the wholesale space, and that such a strategy pretty much forced competitors to exit entirely. And their complaint was that they're weakening the channel overall, and that UWM's public statement has always been that they're trying to grow the broker channel. So they felt that it was in conflict or at odds. And then, so yeah, a little over a week ago, I guess it was 2 weeks now, they said that they would be giving 125 basis points to brokers that they could use as a discount for any loans. But the stipulation is that you could only use up to 40 basis points per loan. And UWM is basically saying, sometimes you just need the discretion. You need, 10 to 20 basis points to win over that real estate agent, or or you can use it to get creative on a borrower's loan. And I think it's a really interesting strategy. And we know already through reporting that Flavia Ferland-Nunez has done that there are other lenders that are interested in basically copying it, that are looking into, how do we do this ourselves? Because it's basically you're incentivizing the borrower. You were trying to get the absolute lowest rates, and the difference between a borrower paying, let's say, just by way of example, let's say 5.4% on a conventional conforming, let's say they have a good credit score, good DTI, good down payment, all that. We're not even talking about buying extra points, right? Let's say the broker decides to use the full 40 basis points that they can use for that loan. That brings it down to five flat, 5.0. Who's competing? There's no way that you could compete, right? And UWM has been really aggressive in its pricing strategy. And I'm a little bit surprised that they're keeping their foot so far on the gas. But there are, I think, some fair questions about really compliance. Mortgage compliance today under the CFPB and HUD is not like it was a few years ago. We know that the CFPB has been looking for scalps. We know that they're a lot more aggressive. We know that they've been hiring far more attorneys, that they're especially interested in looking into fair housing questions. And so Flavia spoke to 3 very prominent mortgage compliance attorneys to look into whether what UWM is doing is even approaching, a legal line here, whether there are any compliance questions related to this program. It's called Control Your Price program. And the 3 attorneys pretty much agreed that UWM doesn't appear to be overtly stepping over any laws, but what they are doing is they're towing the line. There are definitely some things that the 3 attorneys felt that regulators, if so inclined, would be interested in looking at. That doesn't mean that they've done anything wrong or that there's anything illegal. And UWM, for the record, maintains that they are completely above board, that there's nothing, nothing questionable about what they're doing. And but let's get into some of those subjects, right? So there are 3 main areas that these attorneys said would potentially be of interest to a regulator either being from HUD or from the CFPB. I think that would be the scarier proposition. But the first would be LO compensation. And so there is a law called Regulation Z, or really it's kind of a subset of a rule. It's called Regulation Z. It is under the Truth in Lending Act. And basically what it does is it protects Americans when they use consumer credit. So in this application, it prohibits a lender from paying its from paying its broker based on a mortgage transaction's terms or conditions, and really tries to prevent an LO from steering borrowers to loans that would be, more advantageous for them, result in more compensation for them, even if it also results in lower mortgage rates to the customer. I know it's kind of a mouthful, but so Flavia spoke to a top mortgage compliance expert who said the UWM program is great because the borrower gets this more advantageous loan and maybe with a lower rate, but the rule doesn't want loan originators like brokers to be able to play around on a case-by-case basis with their compensation, even though it could be a great thing for the consumer. And the same lawyer added that the industry has been trying to convince the CFPB to allow more compensation concessions, and the CFPB is, generally, as they usually do, has been like, no, we're just not going to do that, and they've flat out refused. Flavia also spoke to another lawyer who said if UWM isn't reducing the broker's compensation to change the mortgage pricing, then the initiative is only a pricing discretion, which is permissible under law. But that does require monitoring, and it does require consistency. So he said, look, if let's say the LO uses its full pool of discounts, and then the next quarter the company comes out and says we're reducing the broker's compensation to make up the difference. The CFPB absolutely does forensic accounting, and this is how they've caught several alleged violators in the past, by basically going through what they said and whether that matches what they do later on, right? So So that does require vigilance. It does require consistency. It requires UWM or any company that it rolls out an initiative like this from being very consistent and not impacting the broker's compensation, right? So you have to have whatever the comp is, it has to remain absolutely consistent with that agreement. And UWM told us that the program does not impact brokers' compensation. So that's the first part, right? That's Regulation Z. There is another regulation, Regulation B, which is under the Equal Credit Opportunity Act, and it basically protects applicants from discrimination in credit transactions. And this one brings the dreaded term disparate impact into focus, and this has been a very tiring, very scary phrase for a lot of people in the mortgage landscape over really quite some time now, but especially over the last few years. And to be a little bit more specific here, it basically means, a lender is employing like neutral policies or practices, but they have an adverse effect, a negative impact on a member of a protected class, even if it's not the intention. And for what it's worth, when there is intention, they call it disparate treatment. So there you have it. But basically, the exclusion here is when lenders' policies and practices meet a legitimate business need. So let's take credit scores, for example, right? So they could be considered a disparate impact because borrowers from specific races and ethnicities often have lower scores. And ultimately, as a result, they would be denied access to mortgage just on that basis, right? But lenders can justify using credit scores with the need to guarantee that they'll have their money back. And that is a legitimate business need. So, the Fair Housing Act is a complicated one. And there are a lot of similar laws in other states that kind of require lenders to be very careful, to not step over the line as it relates to fair housing. So in this example, the lawyer said what could happen is in giving a salesperson the flexibility to make these discounts, there could be fair lending issues if it's not handled correctly. So, let's say you take a group of people and say, okay, here's a bunch of discounts and go give them to whoever you want. And let's say those brokers then give it to only straight white men, who, engage in this kind of, business or practice or whatever. Suddenly, that could be problematic, right? That could obviously be very problematic. And so it is absolutely essential for any lending party to monitor, to make sure that the brokers are not, giving them to borrowers who fit into only this one very specific box. And so, UWM, according to the lawyers, is taking on some affiliated risk by giving the brokers that flexibility. And so ultimately that is on the broker, right? They are entrepreneurs. They are, independent parties who do not work for UWM, but because of the power dynamic here and the various laws that we have, UWM does have to make sure that they are good little boys and girls and that they're not discriminating. And we know that there is discrimination in mortgage. It's not like a fantasy, right? So you have to be really careful about that.
And I think it's a really good point. We're at the end of our time, but there's real discrimination. And then there's also, this is just another layer of, making sure, as you said, the Fair Housing Act is already pretty complicated. We just talked about another layer of the LLPA fees. Like it's not an easy business to make money in. Let's just say that.
No. And if I could have turned back the hands and time, I would have been a mortgage compliance lawyer. That's what I would have done. That's going to be good business for a long time.
That is going to be good business. Well, James, thank you so much for being on today and walking us through some of these great stories. And I hope you feel better soon. I hope your son continues to get better and that we get you on again pretty soon.
Thanks so much, Sarah. Appreciate it.